What if China, the former largest holder of U.S. debt, decided to cut ties entirely with U.S. Treasuries? It's not just a hypothetical scenario. It's a shift already unfolding. With reserves being redirected into gold, BRICS partnerships, and the Belt and Road Initiative, this is more than a financial adjustment. It's a bold strategy to reshape global power dynamics. Imagine the consequences. U.S. borrowing costs skyrocketing, the dollar's dominance facing unprecedented challenges, and global markets scrambling to adapt. As China moves to reduce its dependence on Western financial systems, it's not just changing its strategy, it's rewriting the rules of global finance. Could this be the tipping point that redefines the world economy as we know it? Let's dive into this unfolding story and uncover the implications of this seismic shift. Imagine this. China once held the keys to America's financial fortress, owning over $1.3 trillion in U.S. debt. That's not pocket change. That's reshape the world money. It wasn't just about earning interest. It was about power, influence, and a safety net so big it could catch an entire economy. But here's the twist. China's no longer the top player in this game. That crown? It now sits with Japan. So why did China, the financial giant, step back from the stage? Well, China isn't just sitting back. It's playing a whole new game. Over the years, it's shifted focus to bold initiatives like the Belt and Road Initiative and deepened its alliances within BRICS. It's not just about money anymore. It's about rewriting the rules of global finance. These moves are like China saying, "Thanks, but we'll chart our own path now." It's not a retreat. It's a masterful pivot, one that's sending shockwaves through the financial world. But here's where it gets wild. Pulling back from U.S. Treasuries isn't just about protecting its economy. It's a statement. China is diversifying, stockpiling gold, and reducing its dependence on Western systems. It's like swapping out a single parachute for an entire fleet of safety nets. Bold? Definitely. Risky? Maybe. Genius? Well, that depends on how this gamble plays out. One thing's for sure. It's a move that's shaking up geopolitics and making everyone pay attention. And now comes the big question. What does this mean for the U.S.? How does the world's biggest economy handle losing its biggest lender? Will it bounce back? Or are we looking at a seismic shift in global power? Stick around because the deeper we dig, the more fascinating this gets. Trust me, you're going to want to hear what comes next. Let's rewind to 2013 when China's holdings of U.S. Treasuries reached an eye-popping $1.3 trillion. Back then, it was like having a golden ticket to financial security. Fast forward to 2024, and that number has dropped to about $760 billion. But here's the kicker. This wasn't just a random dip. China deliberately downsized its U.S. debt holdings, shifting those funds into ventures that scream long-term strategy. This move isn't just about numbers. It's about rewriting its economic playbook. So, why the massive drop? The answer lies in China's growing ambition to diversify. With initiatives like the Belt and Road Initiative and increased investments in BRICS partnerships, China is reallocating its reserves to support its global influence. It's like watching a chess grandmaster strategically reposition their pieces, not just for the current game, but for the end game. Every move is calculated. Every decision reflects a broader vision of reducing dependency on Western financial systems. But don't mistake this for a reckless gamble. By diversifying, China reduces its exposure to potential U.S. economic volatility while simultaneously bolstering its own financial independence. Imagine swapping a single savings account for a portfolio of global investments. It's that kind of shift. While this pivot raised a few eyebrows, it's clear that China's looking to secure its position on the global stage, not just for today, but for decades to come. Now, here's where you come in. The story only gets more fascinating from here, and you don't want to miss what's next. Hit that subscribe button and turn on notifications so you can stay ahead of the curve. Trust me, there's so much more to uncover, and you'll want to be part of the select few who truly understand the shift shaping our world. First off, let's clarify what U.S. Treasuries really are. Think of them as the financial rock stars of the global market. Issued by the U.S. Treasury, these securities fund everything from infrastructure to national defense. What makes them so iconic? Safety and liquidity. They're often dubbed risk-free because they're backed by the full faith and credit of the U.S. government. And their liquidity? It's second to none. For anyone seeking stability in an unpredictable world, Treasuries are the go-to investment. Now, here's why countries like China and Japan can't get enough of them. Simply put, Treasuries are a safe place to park massive reserves. Imagine being in charge of a nation's wealth. You wouldn't want to gamble it away. Treasuries are like that dependable vault, delivering steady returns while avoiding the turbulence of high-risk markets. For decades, they've been the bedrock of global financial stability, luring investors from every corner of the globe. But let's not forget, even the most reliable systems face challenges. With U.S. federal debt soaring, the government is issuing more treasuries to fund its growing expenses. While this ensures a steady supply, it also raises tough questions about long-term viability. How much borrowing is too much? Can the U.S. maintain the trust that keeps its treasuries in high demand? These are the kinds of dilemmas that keep financial analysts up at night. So, what happens when major players like China start rethinking their treasury holdings? This delicate balance isn't just a numbers game, it's a geopolitical chessboard. As we dive further into the reasons behind these shifts, the picture becomes clearer and a lot more fascinating. Let's move forward and see how it all connects. Here's the jaw-dropping truth. As of late 2024, the U.S. federal debt has skyrocketed to over $35.4 trillion. Yes, trillion. That's more money than the entire economies of several nations combined. This isn't just a number, it's a weight pressing on the backbone of the global financial system. And guess who holds a big chunk of this debt? Foreign countries like China and Japan, along with domestic investors and pension funds. The question isn't just how this debt grew, it's about what happens next. To keep the government running, the U.S. relies heavily on issuing treasuries. It's like continuously borrowing to fund your lifestyle, except on an unimaginable scale. But there's a catch. As the debt grows, so does the cost of borrowing. Higher interest rates could force the U.S. to spend more on debt repayments, leaving less for critical programs. This delicate balancing act is what keeps policymakers and economists on edge, constantly looking for ways to prevent a tipping point. And let's not forget the ripple effects. Rising U.S. debt doesn't just impact the American economy. It sends shockwaves across the globe. Countries holding treasuries, like China, must weigh the risks of continuing their investments against potential losses. If confidence in U.S. stability falters, it could lead to a chain reaction affecting currencies, trade, and geopolitics. Every percentage point of growth in debt carries consequences far beyond Washington, D.C. So, what does this mean for you? It's not just about the numbers. It's about understanding how these shifts shape your world. Subscribe now and hit that notification bell to stay ahead of the curve. You're diving into knowledge most people overlook, and trust me, the deeper we go, the more fascinating it gets. Let's get to the heart of the matter. Why has China scaled back its U.S. Treasury holdings so drastically? It's not just about money, it's about strategy. Over the years, China has redirected its reserves into projects like the Belt and Road Initiative, BRI, a global infrastructure campaign designed to reshape trade routes and cement China's influence. And that's just the beginning. With deeper integration into BRICS partnerships, China is making a clear statement. It's time to reduce reliance on Western-dominated financial systems. But here's the twist. This move isn't just a financial decision, it's a geopolitical power play. By investing in infrastructure across Asia, Africa, and beyond, China is building a network of economic allies. At the same time, pulling back from treasuries allows it to mitigate risks tied to the U.S. dollar. Think of it as diversifying its power base. It's not about abandoning the game. It's about rewriting the rulebook to suit its long-term ambitions. Of course, such bold moves don't come without challenges. Reducing treasury holdings can signal a shift in confidence, potentially impacting U.S. borrowing costs. But from China's perspective, the benefits outweigh the risks. Diversifying reserves, investing in physical assets, and fostering partnerships worldwide strengthens its position on the global stage. This isn't just a strategy, it's a vision for a more balanced global financial order. And yet, this is only part of the story. How does China's growing focus on diversification shape its broader economic ambitions? And what role does gold play in this evolving narrative? The answers lie just ahead as we uncover the deeper layers of this strategic pivot. When it comes to financial strategy, China isn't just playing checkers, it's playing chess on a global scale. A cornerstone of this game is diversification. Instead of pouring all its resources into U.S. treasuries, China has been steadily increasing its gold reserves. Why gold? Because unlike paper assets, gold is a tangible store of value, immune to the whims of geopolitics and inflation. By stockpiling gold, China is crafting a financial safety net that's as solid as the metal itself. But gold is just one piece of the puzzle. China has also been channeling investments into emerging markets and infrastructure projects tied to the Belt and Road Initiative. These efforts aren't just about building roads and ports, they're about building influence. Every dollar redirected from treasuries to these ventures strengthens China's ties with its partners while reducing its dependency on Western financial systems. It's a calculated move to balance power on the global stage. And then there's the strategic hedge. Diversification isn't just about spreading risk. It's about preparing for the unexpected. With tensions rising in geopolitics, China is making sure its economic future doesn't hinge on the stability of one country or currency. By diversifying its reserves, China gains the flexibility to navigate crises and capitalize on opportunities as they arise. It's a move that signals not just caution, but confidence in its own resilience. But here's the question. How does this reshaping of reserves ripple through the global economy? What happens when a financial giant like China starts shifting its weight away from treasuries? As we dive deeper, the interconnected nature of these decisions becomes even more fascinating. Stay with me. We're just scratching the surface of this intricate web. China's shift away from U.S. treasuries doesn't just make headlines. It shakes the financial landscape. If China were to sell off a significant portion of its remaining holdings, the immediate effect would likely be an increase in U.S. Treasury yields. Higher yields might sound appealing to investors, but they come at a cost: rising borrowing expenses for the U.S. government. This creates a domino effect, potentially straining budgets and reallocating resources from crucial sectors like infrastructure and social programs. On a broader scale, such a move could impact the dollar's role as the world's reserve currency. As one of the largest holders of U.S. debt, China's actions signal a rethinking of global financial norms. A weaker dollar would ripple through trade markets, altering the dynamics of international commerce. Economies dependent on dollar stability could face increased volatility, and nations might look to alternative currencies to anchor their reserves. But let's not forget the resilience of the U.S. Treasury market. Its unparalleled liquidity and depth mean it can absorb shocks better than most financial systems. Even with a major player like China reducing its holdings, there's a long line of domestic and international investors ready to step in. Still, this doesn't eliminate the unease. A more diversified China raises questions about the future balance of power in global finance. These developments paint a vivid picture of a world in flux, where economic strategies redefine relationships and reshape priorities. The implications are vast and complex, influencing not only the U.S., but also the global economy in ways that demand deeper exploration. So, now you know, China's gradual retreat from U.S. treasuries isn't just a financial move, it's a bold reimagining of global power. But here's the kicker. This is just one piece of a much larger puzzle. How many more hidden strategies are quietly reshaping the world economy right now? The kind of knowledge you've uncovered today sets you apart, placing you among those who see the bigger picture. Those who think smarter, act faster, and stay ahead. The question is, will you stop here? Or will you dive deeper? Because there's so much more to discover. Fascinating insights that can help you understand the shifts shaping our future. If you want to keep exploring these game-changing facts, make sure to subscribe to our channel and turn on notifications. Together, we'll uncover the stories that most people overlook. Are you ready to join the few who truly understand?